Picture this, a stock trader glued to their computer screen, heart pounding as they analyze charts, placing bets on individual companies. Now imagine an ETF investor relaxing on a beach, sipping a cool drink, their diversified portfolio steadily growing in the background. These two scenarios represent the contrasting worlds of individual stock investing and ETF investing. Both offer unique advantages and drawbacks, and choosing the right path depends on your risk tolerance, investment goals, and personal preferences. In this essay, we'll delve into the exciting world of stocks and ETFs, exploring their strengths and weaknesses. We'll equip you with the knowledge to make informed investment decisions tailored to your specific needs. Whether you're seeking the adrenaline rush of high-growth stocks or the steady reliability of diversified ETFs, understanding these investment vehicles is crucial for building a successful financial future. So, buckle up and get ready to explore the dynamic world of stocks and ETFs. We'll navigate the complexities together, empowering you to become a savvy investor capable of making smart decisions for your financial well-being. Let's dive in. Individual stocks offer the allure of potentially sky-high returns. When you invest in a single company, you're essentially becoming a part owner, betting on its future success. This direct ownership brings both opportunities and risks. One of the most significant advantages of individual stocks is their potential for rapid growth. Picking the next Amazon or Tesla can lead to life-changing returns, far surpassing the average gains of broader market ETFs. You have the chance to ride the wave of innovation and capitalize on a company's unique strengths. Moreover, investing in individual stocks gives you complete control over your investments. You choose which companies to support and align your portfolio with your values. Want to invest in renewable energy or electric vehicles? You have the power to tailor your stock picks to your specific interests. Finally, many individual stocks pay dividends, providing a steady stream of passive income. These regular payouts can supplement your income or be reinvested to further accelerate your portfolio's growth. However, it's crucial to acknowledge the risks associated with individual stocks. Volatility is a constant companion, and stock prices can fluctuate dramatically in the short term. Economic downturns, industry disruptions, or even company-specific news can send stock prices tumbling, leading to potential losses. Furthermore, successful stock picking requires extensive research and due diligence. You need to analyze financial statements, understand market trends, and evaluate a company's competitive landscape. This level of involvement demands time, effort, and a certain level of financial literacy. Finally, it's essential to remember that investing in individual stocks carries the risk of total loss. If a company goes bankrupt, your investment could evaporate. Therefore, it's crucial to diversify your portfolio and avoid putting all your eggs in one basket. Exchange-traded funds, or ETFs, offer a different approach to investing. Imagine owning a basket of stocks instead of just one. That's the essence of an ETF. These investment vehicles pool money from multiple investors to buy a diversified portfolio of assets. One of the most compelling reasons to invest in ETFs is their built-in diversification. By owning a basket of assets, you're spreading your risk and reducing the impact of any single stock's performance. This helps to smooth out volatility and protect your investments from sudden market swings. Another advantage of ETFs is their low fees, which can significantly impact your long-term returns. However, it's important to be aware of the potential drawbacks of ETFs. While diversification mitigates risk, it also limits potential gains. Section 4: Real-World Showdowns, Stocks versus ETFs. Let's compare the performance of individual stocks and ETFs using real-world examples. Imagine you invested $10,000 in Apple stock in 2010. Fast forward to today, and your investment would be worth over $100,000, a tenfold increase. This example highlights the incredible growth potential of individual stocks. However, let's flip the script and consider investing in a company that went bankrupt, like Blockbuster Video. In this scenario, your $10,000 investment would be worth nothing today, illustrating the inherent risk of putting all your eggs in one basket. Now let's examine the performance of an ETF, tracking the S&P 500 over the same period. While not as dramatic as the Apple example, your $10,000 investment would have grown steadily, likely reaching a value of around $30,000 today. This demonstrates the power of diversification and the potential for consistent long-term growth with ETFs. These examples illustrate the trade-off between risk and reward. Individual stocks offer the chance for outsized returns, but come with the possibility of significant losses. ETFs provide a more balanced approach, sacrificing some growth potential for greater stability and diversification. Section 5. Charting your course. Which investment path is right for you? Choosing between individual stocks and ETFs depends on your financial goals, risk tolerance, and investment timeline. Let's break down which investment style might be suitable for different types of investors. Aggressive growth investors. If you're comfortable with high risk and are seeking maximum returns, individual stocks might be a good fit. Be prepared to dedicate time to research and monitor your investments closely. Passive investors. If you prefer a hands-off approach and prioritize diversification and steady growth, ETFs are an excellent choice. They offer a simple and effective way to participate in the market without the need for in-depth analysis. Long-term investors. If you have a long time horizon and are saving for retirement, a mix of individual stocks and ETFs can provide both growth potential and diversification. Short-term investors. For short-term goals, such as saving for a down payment or a vacation, ETFs or bonds might be more suitable than individual stocks, as they offer greater stability and lower risk. Section 6. The power of both blending stocks and ETFs for optimal results. While individual stocks and ETFs each have unique advantages and drawbacks, combining both in your portfolio can create a powerful synergy. This balanced approach allows you to harness the growth potential of stocks while enjoying the diversification and stability of ETFs. Think of your portfolio like a well-rounded meal. Individual stocks are like the main course, offering the potential for significant flavor and satisfaction. ETFs, on the other hand, are like the side dishes, providing essential nutrients and balancing out the meal. By strategically allocating your investments between stocks and ETFs, you can create a portfolio that aligns with your risk tolerance and financial goals. For example, you might choose to allocate a larger percentage to ETFs for their stability and diversification, while reserving a smaller portion for individual stocks that you believe have high growth potential. Furthermore, combining stocks and ETFs allows you to tailor your portfolio to your specific interests and investment thesis. For instance, you could invest in an ETF tracking the technology sector while also holding individual stocks of companies you believe are poised for significant growth within that industry. Ultimately, the key is to find the right balance that works for you. Regularly rebalancing your portfolio and adjusting your asset allocation as your circumstances change will help ensure that your investments remain aligned with your long-term goals. Section 7. Building your balanced portfolio, a step-by-step guide. Now that we've explored the benefits of combining stocks and ETFs, let's outline a step-by-step guide to building a balanced portfolio tailored to your needs. 1. Define your financial goals. What are you saving for? Retirement, a down payment on a house, your children's education? Identifying your financial goals will help determine your investment timeline and risk tolerance. 2. Determine your risk tolerance. How comfortable are you with market fluctuations? Are you willing to accept potential losses for the chance of higher returns? Understanding your risk tolerance is crucial for choosing the right mix of stocks and ETFs. 3. Choose your asset allocation. Decide what percentage of your portfolio you want to allocate to stocks and ETFs. A common starting point is a 70-30 split, with 70% invested in stocks, including individual stocks and stock ETFs, and 30% in bonds, including bond ETFs. Adjust this ratio based on your risk tolerance and investment timeline. 4. Select your investments. Research and choose individual stocks and ETFs that align with your investment thesis and risk profile. Consider factors such as company fundamentals, industry trends, and ETF expense ratios. 5. Diversify your holdings. Avoid putting all your eggs in one basket. Spread your investments across different sectors, industries, and asset classes to reduce risk. 6. Monitor and rebalance. Regularly review your portfolio's performance and make adjustments as needed. Rebalance your holdings periodically to maintain your desired asset allocation. 7. Stay informed. Keep up to date on market trends, economic indicators, and company news that could impact your investments.